Same as every morning. They wake up, grab their phone, and check the bank notification. And just like that, the smile fades. A few months back, they'd put some everyday essentials on a credit card, and now that balance has climbed into the thousands of dollars. But wait, they've been paying every single month, so why isn't the debt going down? Why is it going up? That one question holds the key to how America's credit card system really works, a system that quietly keeps millions of people trapped in debt for years, sometimes decades. The United States runs one of the biggest consumer economies on Earth. Billions of transactions happen every single day on credit cards. Groceries, hospital bills, gas, you name it. For a lot of people, it's not just a piece of plastic anymore. It's become an essential part of daily life. But behind that convenience sits a system that can quietly pull the careless straight into deep debt. Most of us think a credit card is just a short-term loan from the bank. Borrow it, pay it back, done. In reality, it's not that simple. Most people can't pay off their full balance every month. They pay the minimum, the smallest amount the bank will accept. That one small decision is often where the real trouble begins. Interest starts piling up on whatever's left, and then more interest piles up on that interest. Before long, a debt of a few $100s can balloon into thousands. Some people lost a job, some got hit with medical bills, others just leaned on their card to get through the month. What feels like a temporary fix in the moment slowly turns into a massive financial weight. Plenty of families spend years paying nothing but interest, while the principal barely budges. Here's the part that catches people off guard. None of this is an accident. The system is built so that the longer you carry a balance, the more the bank makes. The more interest you pay, the more they profit.
How it all started. A few decades ago, this card didn't even exist. People paid with cash or checks. After World War II, the American economy started changing fast. Incomes rose, cities grew, new stores, hotels, and restaurants opened everywhere. What the country needed was a way to pay without the hassle of carrying cash. In 1950, a New York businessman named Frank McNamara finished a meal at a restaurant and realized he'd left his wallet at home. Awkward, to say the least. That embarrassing moment sparked an idea. What if there was a card that let you pay without cash at all? That's how the Diners Club card was born, the world's first modern charge card. At first, it only worked at a handful of restaurants, but merchants quickly noticed something. When people don't have to hand over cash on the spot, they spend more.
Big banks took notice fast. In 1958, Bank of America launched Bank AmeriCard, which later became Visa. Around the same time, a group of banks joined forces to create MasterCharge, today's MasterCard. A new race was on. Millions of Americans started getting cards mailed straight to their homes, many without even applying. Through the 60s and 70s, as the economy expanded rapidly, buy now, pay later became part of American culture. Bit by bit, people shifted from a cash mindset to a debt-dependent one. Then technology took over. Magnetic stripes, ATMs, online banking, chip cards, and when the internet arrived, online shopping exploded with credit cards as its backbone. But behind all that convenience was a serious business strategy. Banks don't make their real money just from people swiping cards. Their biggest profits come from customers who can't pay their balance in full. Multiply that interest across millions of cardholders, and you get hundreds of billions of dollars in annual revenue.
Where the trap really kicks in. Take John, just a regular working guy. Late one month, his car breaks down out of nowhere. Repairs run about $5,000. Payday's still a few days off, and he doesn't have that kind of cash lying around. So the card becomes the obvious choice. When the bill shows up, the bank tells him something reassuring. He doesn't have to pay it all at once, just the minimum payment. John breathes a little easier. Seems manageable. He figures he'll chip away at it over time. What he doesn't realize is that interest starts accruing immediately on whatever's left unpaid. That rate is called the APR, the annual percentage rate. And on a lot of cards, it runs anywhere from 20% to 30% or higher. If you don't pay the full balance, interest gets tacked on to what's left every month. In the next month, interest gets charged on that interest too. That's compound interest at work. Compound interest is what makes investors rich, but flip it around to debt, and it works against you just as hard. The longer you carry a balance, the faster it grows. So even though John's making payments every month, most of that money is going straight to interest, and the actual balance barely moves. Do the math a few years down the line, and it's not unusual to find that a $5,000 debt has turned into $8,000 or $9,000 paid, nearly double, and almost none of it went toward the original amount. That's exactly why financial experts say the minimum payment isn't really a convenience at all. It's a long-term trap. Then there's the late fee. Miss a payment deadline, and it's not just a penalty. Many cards trigger a penalty APR, jacking your interest rate up even higher than before. One slip up, and every month after that gets more expensive. Card companies also dangle plenty of tempting perks: cashback, airline miles, reward points. They look like a win on paper, but chasing those rewards leads a lot of people to spend more than they need to. And if the full balance doesn't get paid off in time, the interest charged often ends up outweighing whatever rewards were earned. That's why credit card debt in America isn't just a personal problem anymore. It's a national economic issue. Millions of families funnel a huge chunk of their income into interest payments alone, leaving little room for savings or home ownership.
Who actually profits? If so many people end up trapped in debt, who benefits the most? The answer is clear: banks and card companies. When a customer buys $100 worth of goods, the merchant pays a swipe fee too. Part goes to networks like Visa or MasterCard, part goes to the issuing bank. So even customers who pay on time every month still generate profit for the bank. But the real money comes from people who can't pay their balance in full. Interest that builds up month after month is the bank's single biggest revenue stream. That's why financial analysts half joke that the most valuable customer to a bank isn't the one who always pays on time, it's the one who carries a balance for years. Banks actually have a term for the responsible, always pays in full customer, a deadbeat. Ironic, considering that's the person being financially disciplined, but from the bank's business model, they're not profitable at all, since no interest ever gets collected from them. On top of that, there are annual fees, cash advance fees, balance transfer fees, a pile of smaller charges that plenty of people agree to without reading the fine print. All those small fees add up to another major income stream for the bank. That's also why new card offers never stop coming. Apply today, no annual fee the first year. Because banks know, the more people who use a card, the more chances they have to profit. That doesn't mean everyone falls into the trap. People who pay their balance in full every month stay relatively safe. But unexpected expenses, job loss, or medical bills pull plenty of others into the cycle, regardless of how careful they try to be.
So where's the way out? Credit cards themselves aren't the villain here. Pay the full balance on time, and you never pay a cent of interest. Used well, a card builds your credit score, which later helps you get lower rates on a mortgage or car loan. Fraud protection, emergency backup, those are real upsides too. The problem isn't the card, it's the system that makes borrowing easy while making the true cost hard to see. A single small decision, like sticking to the minimum payment or paying a bill late, can quietly snowball into a much bigger problem down the line. For anyone trying to break the cycle, the basics still hold up. Pay the full balance whenever you can, pay more than the minimum when you can't, and if you're carrying balances on multiple cards, knock out the highest interest one first. Small habits like these make a real difference over time. That's exactly why understanding personal finance matters more today than it ever has. America's credit card system offers a bigger lesson here too. Financial freedom isn't just about how much you earn, it's about how you use what you earn. Someone making 6 figures a year can still drown in debt, while someone earning far less can build a secure future with the right habits. Real wealth isn't the numbers sitting in a bank account, it's the quality of the financial decisions behind it. How a small piece of plastic turned into one of the most profitable businesses on the planet, and why millions of Americans are still carrying its weight, that's the story here. Funny enough, the exact same card can be a blessing in one person's life and a nightmare in another's. The only difference is understanding and habit. And this lesson isn't just about America. The rules of debt and interest work pretty much the same way in every economy on Earth. A credit card can be your best friend or your worst financial enemy. The difference comes down to one thing. Do you actually know the rules, or are you unknowingly playing right into them? If you enjoyed this kind of deep dive documentary, subscribe to our channel. Drop a like if this was useful. Let us know your thoughts in the comments and share it with a friend who needs to hear this. See you in the next one.